Good morning. Today is July the 15th, and hi, Andy. Let's start with what happened last week.
It was a pretty meaningful week, I think. We've been setting up for this week with the markets getting very higher for longer as we've expected, and probably almost certainly have overdone it a little bit. The data came in, the CPI and PPI data came in light, slightly lower than expectations, continuing the trend that we've been, and I think everyone has been seeing, which is downward pressure on inflation. Still at a high level, but still downward. Auctions were large and they went reasonably well. And then on Thursday, the unemployment numbers were warm. They indicate a strong labor market. Nonetheless, equities rallied. Actually, all assets rallied, led by the yield curve disinverting as well as equities and gold rallying. And all of those seem to be sensible reactions to this idea that inflation, things that markets are stabilizing in a declining inflation environment, and that the Fed may succeed.
I think what the market is trying to do is price in the likelihood of two rate hikes being necessary by the end of the year. And basically, whenever he gets hot data on the economy, it goes to two hikes. And whenever he gets something which is slightly better than that, like we had last week, as you say, with the CPI and the PPI, it goes back to one hike. I think that we might agree that this month's hike is probably baked in. I think the odds that the Fed hikes 25 in July are very high. The market is now arguing about is whether the second hike later on in the year is going to be necessary or not necessary. And therefore, every time the market sort of prices in the two dot plots that we had, it can't go any further. And every time it comes down to the one, it can't go any further better. Therefore, we're stuck in a 25 basis point trading range in the very short end. And those moves are very rapid between one extreme and the other extreme as the curve moves and people get squeezed in and out of positions. So that is the situation that we're in. But we probably can both agree that lowers the overall level of volatility within a certain parameter that is unlikely to be crossed one way or the other.
Yeah, you're really talking about 25 basis points in Fed funds, per- broadcasting itself a narrow range, literally 25 basis points in the next 6 months, broadcasting itself out to all asset markets and constraining volatility. Yeah, I think that's true. Also interesting is as you look forward for the summer, the Fed is going to meet and they're going to hike 25 and they're going to not talk about quantitative tightening and they're going to not have a dot plot to refer to. So they're going to leave 25 basis points on additional hikes on the table. They're not going to take it off. They're not going to add 25 basis points. Now, they may have to either take it off or add 25 basis points by the September meeting, which will have a new dot plot, and that might actually instill some volatility, but that's a long way off.
Yeah. So basically, what we're saying is that the volatility of all assets is likely to decline into the summer, certainly until August the 2nd, when we have the refinancing quantities.
Announcement. Yeah. Mhm.
And that is likely to constrain us for the next month or so.
And I think earnings, which are those, there's so just looking forward in terms of we have the Fed meeting, we have that quarterly refunding announcement, and we'll have more to say as we get closer to those events. But earnings have begun to come out. Banks were fairly across the board strong, and I would expect, given the high level of nominal GDP, that earnings will continue to be strong across the board. But at the same time, in the last quarter, the equity markets are up 8 or 9%. And so, not surprisingly, it's also expected. We're going to get these earnings, and they're going to be like JP Morgan. You get a 4% pop on the best earnings in history. and then the market retreats back to up a 0.5% or 1%. And it's low vol. And you don't have to rush in your portfolio decisions at this stage, given that earnings are going to be great, Fed's going to hike, employment's going to stay strong, which is what they care about to kill inflation. But CPI and PPI and PCE are going to continue to come down, as they should, because the Fed is having an effect. And then we'll see whether they actually do what they need to do, which is curb employment strength. And if they don't, then they'll need to hike more. And if they do, they'll be done. But the short term is pretty straightforward.
And is there anything that's going to happen next week that you can see that is going to take us away from these parameters?
Well,
Not really, right?
I don't think so. We've got retail sales in the US. That's data. It should be strong. There's a wild card out there, which is the BOJ changing their yield curve control policy that could have an impact on markets. I don't believe that's next week. I think it's
No, it's the week after.
the following week. That'll be something that will at least be on our minds as when we talk to you next week, because that'll have an impact on global bond markets one way or the other. But yeah, we have CPI in Europe and the UK. The expectations are they are at a higher level and are heading in the same direction, which is less. And so I don't suspect we're going to get a hell of a lot of surprise in the next week.
Yeah, I agree with you. And our macro outlook hasn't really changed. It's still higher for longer, but with a lower volatility of the inflation expectations and where the market is going to trade. As I said before, between one hike and two hikes and rebounding up and down. So really all we're looking for is earnings, which are, as you say, are likely to be good because of the strength of the nominal economy, and therefore very little overall change in asset prices over the course of the next couple of weeks,
Yeah.
unless the Fed says something incredible, which I don't think they need to, because they should be quite comfortable with the situation that we're in.
Yeah, I'm a little concerned that asset prices are a little ahead of the Fed and may have a wealth effect impact on the need for further tightening, meaning they might need to tighten more, but that'll play out. And it'll play out principally through the jobs numbers, and we won't get a jobs number that matters through the next. We'll get the regular Thursday announcements, which will likely stay warm, but we won't get any meaningful job data until August. Yeah, the one thing on inflation volatility is the expectations have been very tightly pinned to the target for a long time, and they should be. The Fed's heading in the right direction. The question is, will they become deflationary if we keep heading in that direction and be a inflation expectation below target, or will they stay fixed at target, or will they rise? And for right now, I see fixed at target as being the most likely outcome. You're going to have to get a surprise.
If we look at the way the swap market is pricing things, they are not lowering the inflation expectations. They're still sticky on a 5-year outlook around the 2.3%. I think what's come down is the likelihood that they will make new highs or make new lows. And that is bringing down, as we said, the MOVE index, which is the volatility index of bonds. And that is bringing, in turn, supporting the lower VIX and therefore constraining the movement in the markets. What should we do probably is change our portfolio slightly to reflect these realities, because at the moment we are long of calls. What has been the performance of our long calls? It's been very good.
Yeah.
It certainly kept pace with the equities that we sold, and we gained optionality and we lowered the volatility of return of the portfolio. Is there anything that you think that we should do at the moment to change that?
Yeah, remember why we did this. At the time, we were suspicious that equities had moved too far. I think the S&P was a little lower than it is right now. And yet we wanted to maintain exposure. So we did what's called a stock replacement trade, where we sold our equities and bought calls. And the reason why that was so attractive is because volatility had been priced at a very low level. And we've had an increase in volatility, which is good for our calls. And we've had an increase in the market, which would have been good for our stocks that we were long, but was levered in our calls. That trade worked out from a risk reward standpoint in all ways. But now, as you and I talk about this, I'm suspicious that we're going to be in a narrow range, and that will cause our calls to decay. So it seems to me to make sense to sell some volatility. And we can do that in a couple of ways. If we sold our calls outright, all of our calls outright, that would leave us underinvested in equities. And it's not the time to, equities have rallied a lot. Is it time to, we said the markets are going nowhere. So is it time to dump equities? No. So I'd like to maintain our equity exposure, but if we end up selling the calls completely and and then buying equities, then we expose ourselves to this recent relatively big move up 100 points in the S&P in the last week. And I'm not really in love with that. So I'm trying to think of a better way. What do you think would achieve our goal to getting out of some of our volatility exposure while still maintaining, not chasing equities, but still maintaining some sort of equity exposure?
We have two SPY calls and we have some Dow. Really, probably the most sensible and the middle way to do it would be to sell one of the calls that we have, because we are now at strike plus premium paid. So if we halve that exposure and we sell a put struck at the same level as we have at 440 in the SPY, then and really what matters here is the strike and the maturity, i.e. the expiry of that option. Because if we do it to just after the Fed meeting, i.e. to that Friday of the Fed meeting on the Wednesday, we actually get some vol for that. And really we retain the optionality, because as we said, we don't mind buying stocks if they come back to 440 in this environment, but at 450 in the SPY, we are very doubtful that we can go much higher, and therefore selling one call and selling one put struck at 440, and I can show that in my later segment, would probably satisfy our equity position and not take us outside of any risk parameters that we have.
That sounds great. I'm good with that. Makes sense to me. Take some of our premium off the table and stay constructive on equities and willing to buy the dip. That makes plenty of sense.
And finally, I think that what we ought to talk about is our bond position, which at the moment consists of VWOB. And it's important to understand why we have VWOB as opposed to TLT. Although both of them have roughly the same duration perspective, what's important with VWOB is that we get a 5% coupon monthly, and we have an over 7% yield to maturity with the same duration characteristics as TLT. Therefore, we're taking on more risk in inverted commas because we have lower quality names here. We have, if you have a look at the composition of VWOB, it's Kuwait, it's Middle East, it's emerging or Eastern Europe, whatever you like to call it. But it gives you so much more yield than an equivalent US Treasury does.
Right.
And I think,
and it's US dollar denominated.
yeah, so we don't have the currency risk, we have the credit risk. But what we are saying, or what I think is more likely to happen, is that if the market perceives the inflation going forward in US dollars is going to be within a tighter range, then those differentials should come in, i.e. the credit spreads will come in over time. And therefore, VWAB continues to be a much better investment longer term than TLT, for example. And I think that we should up our duration is very low because what we have is tips and we have the floating rate note, which is the duration of almost nothing because it resets every couple of weeks. So what we need to do is up our duration, and really VWAB or an equivalent, the JP Morgan of ETF, which I think is EBD, much of a muchness between those. I think we should up that. I don't know if you agree with that.
Yeah, my only hesitation is that I think U.S. long-term bond yields, TLT in particular, isn't going anywhere, and I think yields need to go higher. This offers a chance to wait and generate high current yield, high yield to maturity relative to TLT, with not, to me, a tremendous amount of risk. Yeah, that makes sense to me. What do you think? Go up to 20% from 14?
Yeah, take some. If we sell the floating rate note, which is yielding 5.25, let's call it, but we get a 5% coupon from VWOB plus the higher, the much higher yield to maturity, I don't think we will be doing much harm to the portfolio, even if TLT backs up a little bit, which is likely to do in the next couple of weeks, because really TLT is still in a downtrend. So what I'd like to do is leave a bid at a decent level in VWOB, and I'll explain that in my later segment.
Excellent. I'm in your hands. Thanks, Nick.
Thank you very much indeed, and until next week, have a lovely summer. Let's have a look at what the portfolio looks like and what the changes will be. We're doing all right. We are keeping up with the market on our calls, which are not in this analysis. So what we are going to be doing is changing the composition of the calls so they're in order entry. We will be selling one of the August 18 440 calls that we have, leaving us with one. And we will be selling one 440 put to the 28th of July as described in here. And I will do that at market on Monday morning. VWOB, we are leaving a limit order at 62.10. Many reasons why it's at 62.10, but primarily because that is a level of TLT that I like, and the composition and the spread between TLT and VWOB that you can find in the chart pack basically comes up, and it's somewhere around the 164 level. So that is the way that I price my relationship between TLT and VWOB. If we now go back to the broker statements, you will find that there are two broker statements here because one of the subscribers remarked that he couldn't see the levels that I trade in the broker statement that we put up before, and that is in the second broker statement, which has the exact levels that every trade is done at. So now, from now on, I will include two broker statements as opposed to one, so everything is fully transparent. These are the orders, these are our positions. Have a great weekend.